Welcome to this explainer. Today, we're going to run a full financial diagnostic on the cybersecurity firm Qualys. We really need to figure out, is its recent massive stock drop a huge red flag, or are we looking at a rare generational buying opportunity? Let's just dive right in, because honestly, the data we're about to look at, it shows one of the most fascinating disconnects between a company's stock price and its actual underlying business fundamentals that I think we'll ever see. So, here's how we're going to structure this diagnostic. 5 clear steps. We'll start with the price drop mystery, look at revenue and profit growth, check out operating efficiency and margins, compare some valuation multiples, and then wrap it up with our final fair value verdict. All right, step 1, the price drop mystery. Let's get right to the core tension surrounding Qualys stock right now.
The market has literally punished the stock lately. It's down 32.26% year to date. And if you zoom out a bit to its 52-week high of over $155, well, with the price currently sitting right around $90, that means it's trading more than 42% below its recent peak. Basically, short-term market sentiment here is, well, it's overwhelmingly negative.
But, and this is a big but, against all that gloomy short-term price action, just look at the underlying math. The calculated fair value price, which is derived directly from the actual cold hard cash the business generates, sits at an astonishing $622.95. I mean, really think about that for a second. We're looking at a stock trading near $90, yet the cash flow suggests an intrinsic value hundreds of dollars higher. That right there, that's the exact mystery we're here to unpack.
Now, this perfectly captures the stock's wild, volatile journey. Looking at the timeline, 2024 with a 28% drop. And early 2026, they've been absolutely brutal. But historically, this stock has explosive potential. Just look at 2017. It brought an 87% gain. And as recently as 2023, it surged almost 75%. So despite this recent crash, if you've held this for 10 years, you're still looking at a compound annual growth rate of over 13%. Basically, this stock moves in massive swings.
Okay, moving to section 2, revenue and profit growth. The stock price is clearly down, but what does the actual business growth look like under the hood? Like, is the business itself shrinking?
Well, the short answer is absolutely not. In fact, the company's internal engine is roaring. Looking at their 5-year compound annual growth rates, we see strong double-digit expansion across the board. Revenue, up nearly 13% annually. Free cash flow is matching that pace at over 13%. And net income, that is growing at a super robust 22.49% every single year. So the top line is growing, sure, but the bottom line is growing even faster. But what's really wild here is the sheer scale of their earnings explosion. Earnings per share has grown at a staggering 5-year compound annual growth rate of almost 210%. I mean, wow. This isn't some stagnant legacy tech company. This is a highly profitable machine that's aggressively expanding its earnings footprint year after year. It's like it's completely ignoring the pessimism we just saw on a stock chart. Which brings us to section 3. Operating efficiency and margins. Because, growth is fantastic, but growth at all costs, that can be dangerous. Let's see how well Qualys actually manages those growing revenues.
If you're a fundamental investor, this financial profile is pretty much a dream. Qualys operates with absolute financial discipline. They have zero reliance on debt, like a debt-to-equity ratio of exactly 0. On top of that, they boast a massive return on invested capital of nearly 33%, which means every dollar they put back into the business generates an exceptional return. And with a current ratio of 1.43, they've easily got enough cash on hand to cover their short-term bills. This is exactly what a bulletproof balance sheet looks like.
Let's zero in on that gross margin for a second. To put that into perspective, keeping over 82 cents of gross profit on every single dollar earned, that gives this business unbelievable operational flexibility. Sure, software companies generally have high margins, but 82% is elite level. It means that as their revenue scales up, the vast majority of that new money flows right down to the operating level. It funds further growth or just drops straight to the bottom line without being dragged down by high costs of goods sold.
And because of that incredible efficiency, their current free cash flow yield sits at 9.20%, and the earnings yield is at 6.38%. But here's the crucial part. How does this compare to their history? Well, both of these yields are currently up over 74% compared to their 5-year historical averages. So essentially, the business is generating significantly more cash relative to the cost of buying a share today than it has at almost any point in the last half-decade.
All right, now we arrive at a really critical part of our diagnostic. Section 4, Valuation Multiples Compared. We've got this highly efficient, cash-printing business with zero debt. So how is the broader market currently pricing all this efficiency and growth?
Well, the traditional valuation metrics prove the narrative that this stock is trading at a steep historical discount. The current price-to-earnings ratio is 16.16. For a high-margin tech company, that's already low. But compared to its own 5-year average, it's sitting at a 53% discount. Price to sales is down 45%, enterprise value to EBITDA is down nearly 48%. Basically, across every major traditional valuation metric, Qualys is currently on sale for roughly half off its historical average.
And let's factor in growth to see how this builds. The PE ratio, which, if you remember, divides the PE ratio by expected earnings growth, sits at a very reasonable 1.16. So even when you adjust for growth expectations, the stock is nearly 24% cheaper than its average over the last 3 years. The market has seriously compressed the premium it used to willingly pay for this business.
Okay, we've seen the symptoms, we've checked the vitals, and we've looked at the price tag. Now for Section 5, the fair value verdict. Let's look at the final prognosis. Based on discounted free cash flow metrics, Qualys currently offers a massive calculated margin of safety of 85.55%. A margin of safety that high means that even if future growth slows down considerably from current projections, an investor buying at today's prices is deeply insulated from permanent capital loss, and that's based solely on the cash the business already generates today.
And here's how those models actually shake out in dollar terms. If we calculate fair value using an earnings per share growth model, the target is $460.19. If we use a free cash flow model, that target jumps to $622.95. Now remember, the stock recently closed right around $90, so even if you assume these models are way overly optimistic and you literally cut those fair value targets in half, the intrinsic value math still points to a stock that is deeply, historically undervalued.
Which leaves us with this final, absolutely crucial question to ponder as we wrap up this explainer. With zero debt on the balance sheet, soaring 82% gross margins, double-digit growth, and an 85% margin of safety, is the broader market simply blind to the big picture on Qualys right now? Or is there some invisible, qualitative risk lurking out there in the cybersecurity space that perfectly structured historical metrics simply can't see? It really is a fascinating standoff between price and value. Thank you so much for joining me, and as always, keep questioning the data.